Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today I will be talking about International Paper. International Paper is one of the world's leading producers of fiber-based packaging, paper, and pulp. The company has about 25,000 customers and it serves in more than 150 countries. Today we'll briefly go over the company's business segments, then review the company's fundamentals by focusing on its key ratios, and finally find the intrinsic value of the company. So let's dive in and review International Paper.
Hey guys, let's start off by looking at the company's business and its operating segments. I got this information from the company's annual report. The International Paper Company operates as a paper and manufacturing company primarily in the United States, Middle East, Europe, Africa, Pacific Rim, Asia, and rest of the Americas. It operates through three segments: industrial packaging, global cellulose fibers, and printing papers. The industrial packaging segment manufactures containerboards, including linerboard, medium whitetop recycled linerboard, recycled medium, and saturating kraft. The industrial packaging segment accounted for about 73% of the company's 2020 sales. The next operating segment is its global cellulose fibers segment, which provides fluff, market, and specialty pulps that are used in absorbent hygiene products, tissues and papers, and non-absorbent end applications. The global cellulose fibers segment accounted for about 12% of the company's 2020 sales. Finally, the third operating segment is its printing papers segment, which produces printing and writing papers. This operating segment brought in about 12% of the company's 2020 sales. So amongst these three segments, we can see that the industrial packaging segment brings in the lion's share of the company's revenue. Now that we have a brief understanding of the company's business and its three operating segments, let's review the company's fundamentals by focusing on its key ratios. Hey guys, now let's look at the key ratios. I'm on Morningstar looking at International Paper Company. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2011, the company's revenue was about $26 billion. It rose up to about $29 billion back in 2013. And ever since then, the company's revenue has slowly been declining. And for the trailing 12 months, that number was about $21.9 billion. Ever since 2016, it appears that the company's revenue has hovered between $20 to $23 billion range. Next, looking at the gross margin. The gross margin gives an idea of how much money is left with the company once it has paid for its cost of goods. This means is every $100 that the company made in 2011, by the time it paid for its cost of goods, it had $27.2 left. Similarly, for the trailing 12 months, every $100 that the company made over the past 12 months, by the time it paid for its cost of goods, it had $30 left. Ideally, we want to see the company's gross margin to be staying steady or increasing. An increasing gross margin tells us that the company is becoming more efficient at controlling its costs of production. We can see that over the past few years, the company's gross margin has stayed fairly consistent. Next, looking at the operating income. The operating income is what we get when we subtract the cost of goods and operating expenses from the company's revenue. Back in 2011, the company's operating income was about $2.3 billion. And for the trailing 12 months, that number was about $1.8 billion. Over the past 10 years, the company's operating income has hovered between 1.6 to $2.9 billion range. Next, looking at the operating margin. The operating margin is the ratio of the company's operating income to its revenue. Ideally, we want to see the company's operating margin to be staying steady or increasing. Back in 2011, the company's operating margin was about 9%, and for the trailing 12 months, that number was about 8.3%. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it pays for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2011, the company's net income was about $1.3 billion, and for the trailing 12 months, that number was about $1.8 billion. Ideally, we want to see the company's net income numbers to be staying steady or increasing. Over the past 10 years, the company always had a positive net income number, which tells us that the company has always reported a profit. Next, looking at the dividends per share. Back in 2011, the company paid out about 97 cents per share as dividend, and for the trailing 12 months, that number had grown to about $2.05 per share. International Paper has been paying out dividends every year. In fact, it has been hiking its dividends every year for the past 10 years. Next, looking at the shares outstanding. Back in 2011, the company had 437 million shares outstanding. That number grew to about 448 million shares back in 2013. And ever since then, the company shares outstanding number has been trending downwards. Ideally, as investors, we want to see a company that is buying back its shares, as this process of buybacks actually helps increase the existing shareholders' ownership within the company. The way the company has been paying out its dividends and the way that the company has been buying back its shares tells us that the management is shareholder friendly. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2011, the company's book value was about $16.94 per share, and for the trailing 12 months, that number was about $24.85 per share. Over the past 10 years, the company's book value has always been positive, which tells us that the company always had more assets than liabilities on its balance sheet. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2011, the company's free cash flow was about $1.5 billion, and for the trailing 12 months, that number was about $2.3 billion. International Paper always had positive free cash flows. Ideally, we want to see the company's free cash flow to be positive, staying steady, or increasing. I will be using the 2020 free cash flow of $2,312 million from my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2011, the company's net margin was about 5.15%, and for the trailing 12 months, that number was about 8.2%. What this means is every $100 that the company made over the past 12 months, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had about $8.2 left as pure profit. Next, looking at the return on equity. The return on equity is the ratio of the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Back in 2011, the company's return on equity was about 20%, and for the trailing 12 months, that number was about 21.5%. Every year except 2020, the company's return on equity has been greater than 8%. Next, looking at the return on invested capital. The return on invested capital gives an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2011, the company's return on invested capital was about 8.37%, and for the trailing 12 months, that number was about 9.66%. The company's weighted average cost of capital, also known as the company's hurdle rate, is about 4.94%. And since the company's return on invested capital is greater than its weighted average cost of capital, we can safely say that the management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest obligations using its income in that calendar year. Back in 2012, the company's interest coverage was about 2.38 times, and for the trailing 12 months, that number was about 4.81 times. Benjamin Graham, the father of value investing, preferred to only invest in securities that had an interest coverage of 5 times or higher. However, International Papers' interest coverage is not too far off from the industry standard, whose interest coverage runs between 2 to 5 times. Now let's look at the company's financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to see the company's current ratio to be greater than 1.0. It's even better if it's greater than 1.5. A current ratio greater than 1.0 tells us that the company has enough current assets to fulfill its current liabilities. Back in 2011, the company's current ratio was at 2.21, and for the latest quarter, it's at 2.11. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. A quick ratio greater than 1.0 tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2011, the company's quick ratio was at 1.58, and for the latest quarter, it's at 1.30. Next, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. A financial leverage of 1.0 tells us that all of the company's assets are financed via shareholders' equity. A high financial leverage tells us that more of the company's assets are financed via liabilities. Back in 2011, the company's financial leverage was at 4.08, and for the latest quarter, it's at 3.06. Over the past 10 years, the company's financial leverage peaked around 2015 when it got to a high of 7.88, and ever since then, the company's financial leverage has slowly been trending downwards. Finally, looking at the debt to equity ratio, this ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt to equity ratio to be less than 1.0. Back in 2011, the company's debt to equity ratio was at 1.39, and for the latest quarter, it's at 1.10. The company's debt to equity ratio has a similar trend as the company's financial leverage. Now let's look at the efficiency ratios. The first item on the list is the day sales outstanding. This number gives an idea of how many days go by from the day the company recognizes its sale to the date it actually receives cash for that service rendered. Back in 2011, the company's day sales outstanding was about 45.7 days, and for the trailing 12 months, that number was about 55 days. Ideally, we want the company's day sales outstanding number to be staying steady or decreasing. What we do not want to see is a company whose day sales outstanding number is growing rapidly, as that tells us that the company is being aggressive with its accounting, as it's trying to recognize its revenue sooner so that it can inflate its income numbers on its income statement. However, International Paper does not appear to play any such shenanigans as its days sales outstanding number has stayed fairly consistent over the past few years. Next, looking at the days inventory, this number gives an idea of how many days does the company's products sit in its inventory before they're sold. Back in 2011, the company's days inventory was about 45 days, and for the trailing 12 months, that number was about 48 days. Ideally, we want the company's days inventory number to be staying steady or decreasing. Next, looking at the payables period, this number gives an idea of how many days does the company take to pay its suppliers. Back in 2011, the company took about 49 days to pay its suppliers, and for the trailing 12 months, that number was about 59 days. Ideally, we want the company's payables period to be staying steady or decreasing. What we do not want to see is a company whose payables period is growing rapidly, as that tells us that the company may be trying to hold on to its cash in order to artificially inflate its cash flow numbers. Again, it does not seem that the company's management is playing any such shenanigans, as the company's payables period has stayed fairly consistent over the past few years. Finally, looking at the inventory turnover, this number gives an idea of how many times does the company go through its inventory in a calendar year. Back in 2011, the company's inventory turnover was about 8.13 times, and for the trailing 12 months, that number was about 7.56 times. Ideally, we want the company's inventory turnover to be staying steady or increasing, and we can see that over the past few years, the company's inventory turnover has stayed fairly consistent. Now let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. International Paper has a price to earnings of 10.1, whereas S&P 500 is at 24.0. Next is the price to book ratio. International Paper has a price to book of 1.8, whereas S&P 500 is at 4.4. Next is price to sales. The company has a price to sales of 0.8, whereas S&P 500 is at 3.1. After that is the price to cash flow. The company has a price to cash flow of 6.7, whereas S&P 500 is at 17.7. And finally, the dividend yield. International Paper has a dividend yield of 4.4%, whereas S&P 500 is at 1.5%. So we can see that on all these valuation metrics, International Paper is undervalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for International Paper. Over here, I pasted the company's 2020 free cash flow number that I got from Morningstar, which was at $2,312 million. I'm assuming the annual growth rate of free cash flow to be 4%. What this means is I expect the company's free cash flow to grow at 4% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate of 3%. What this means is after the 10-year mark into perpetuity, I expect the company's free cash flow to grow at 3%. The company has 396 million shares outstanding and has a long-term debt of $10,156 million. After taking all of these inputs into account, we get the company's intrinsic value to be about $64.15 per share. And when we compare this intrinsic value to the company's current stock price, which is about $46.45 per share, we can see that the company's current stock price is trading about 28% below the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $17.2 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all these up to get the intrinsic value to be about $36 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $64.15 per share. Now, if we disregard the perpetuity component, in other words, if you think that International Paper is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $17.8 per share. Finally, if we disregard the debt, in other words, if you think that International Paper is going to grow into perpetuity, so there's no point for the company to worry about paying off its debt, then we get the intrinsic value without the debt to be about $90 per share. So overall, we can see that International Paper is an undervalued security, not only from a discounted free cash flow DCF analysis standpoint, but also when we compared the company's current valuations to those of S&P 500, we saw that International Paper is undervalued. Additionally, the company's management is very shareholder friendly, as the company continues to buy back its stock and pay out steadily increasing dividends. Hey guys, that is all I had for you this week. Hopefully you found this video on International Paper interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.